Chapter 9, Absorption Costing and Marginal Costing. Chapter 9, Part 3. We are going to focus on 9.4, the format of income statement. Income statement, normal and actual costing. Do you remember that what you have did for the income statement? Yeah. Under income statement, we have two costing system. We have actual costing system and we have normal costing system. Under actual costing system, we are calculate the actual of direct material, the actual direct labor, and the actual overhead manufacturing, either variable or fixed overhead. Under normal costing system, the difference compared to actual costing system is absorption overhead, and you have an actual direct material and actual direct labor. So the difference between actual and normal is the manufacturing overhead. Under actual, using the actual overhead, but under normal costing system, we are using the absorption overhead. Okay, we look into the income statement. Okay, now we look into the normal costing system. This is the income statement, absorption costing under normal costing system. The format is the sale less cost of goods sold with the beginning inventory plus with the cost of good manufacture. We got cost of good available for sale less ending inventory. We get the cost of goods sold, and we have to plus add under applied overhead or less over applied overhead, and then we get the adjustment cost of goods sold, and sale minus adjustment cost of goods sold, do you get gross profit? So in here you can see that under normal costing system you have either under applied overhead or over applied overhead. So if you have an under applied overhead, you have to add to the cost of goods sold, or either you have the over applied overhead, you have to less from the cost of goods sold. Okay, and then from the gross profit, less the operational expenses, fixed and selling administrative, variable selling administrative, and then you will get the net profit. Normal costing system income statement under marginal costing is where sale less variable cost of goods sold, okay, is the beginning inventory plus cost of good manufactured, okay, and then you have the less with the ending inventory. Okay, you got a variable cost of goods sold plus with the variable selling and administrative, so you will get the total variable cost. Sale minus total variable cost, you will get contribution margin. And then you have to less with the fixed cost, fixed manufacturing overhead, selling and administrative expenses. So you will derive to the net profit. Look into the example. Syarikat Semegah practice normal costing system. The company normal production is 24,000 units per year. Annually estimated manufacturing overhead cost, fixed overhead 240,000. This will be the operational data for 2015. beginning inventory 2,000, unit produced 20,000, unit sold 17,000, direct material per unit 20 ringgit, direct labor per unit 10 ringgit, variable overhead 56,000 ringgit, fixed overhead 180,000 ringgit, selling price per unit 100, variable and selling and administrative expenses per unit 10 ringgit, fixed selling and administrative expenses 170,000. Using absorption and marginal costing. Required. The first one, calculate cost product. B, calculate under or over applied overhead. C, prepare income statement for the year ended 31st December 2015. And D, prepare reconciliation net profit. By using a normal costing system, we have to compute per unit product cost. We look into the absorption costing where direct material actual cost 20 ringgit, direct labor actual cost 10 ringgit. We look into the variable manufacturing overhead. In this question, there is no estimate on the variable manufacturing overhead. Therefore, you have to use the current variable overhead cost divide by current production unit. 56,000 ringgit divided by 20 ringgit, so you get 2 ringgit and 80 cent. Next is a fixed manufacturing overhead. For this question, you have to use the predetermined fixed overhead rate, where estimated annual fixed overhead cost divided by estimated production unit. So, amount of RM 240,000 divided by 24,000 unit normal production, so you will get 10 ringgit, and the total cost, product cost, is the 42 ringgit and 80 cent. By using the marginal costing, you have to direct material actual 20 ringgit, direct labor actual 10 ringgit, and variable manufacturing overhead by 2 ringgit and 80 cent. Meaning that the total unit cost for marginal costing is 32 ringgit 80 cent. Next, we are going to look into the under or over apply of manufacturing overhead. So we look into the fixed manufacturing overhead. Manufacturing overhead applied is RM 10 ringgit times 20,000 current production, therefore 200,000. Compare with the manufacturing overhead incurred for the current year 180,000. Therefore, there is a 20,000 excess, meaning over applied fixed manufacturing overhead is 20,000. Under or over applied manufacturing overhead in the income statement of the year in absorption costing, involving under or over applied fixed overhead because the computation of the per unit production cost include fixed. So meaning that over applied fixed manufacturing overhead 20,000. Preparation of income statement, adjustment of the under and over applied manufacturing overhead in the income statement, absorption costing under normal costing system, over applied manufacturing overhead 20,000. The adjustment reduce the overhead costs that have been applied to be equal with the overhead costs incurred. Meaning that debit manufacturing overhead 20,000, credit cost of goods sold 20,000. So next you have to prepare of the income statement absorption costing under normal costing system. Title Syarikat Semegah Income Statement Absorption Costing for the year ending 31st December 2015, we have sale 1.7 million, start of beginning inventory 85,600, plus cost of good manufactured 856,000, cost of good available for sale 941,600, minus ending inventory 214,000. Okay, any inventory is come from the beginning inventory plus unit produced minus unit sold. Then you get cost of goods sold 727,600, and then you have to minus over applied overhead 20,000. So adjustment cost of goods sold 707,600. So the gross profit sale minus adjustment COGS. So your gross profit will be 992,400 less operational expenses fixed and selling and administrative 170,000, and then you have the variable selling and administrative. So the variable is based on a unit sold times with the variable selling and administrative per unit. So you will get 170,000 in here, and the total of operational expenses is 340,000. Gross profit minus the operational expense, you get a net profit of 652,400. Under the marginal costing of income statement, you have a sale 1.7 million less variable cost. Where variable COGS, you have a beginning inventory 65,600, cost of good manufactured 656,000. You have a cost of good available for sale 721,600, less ending inventory 164,000, and then you get the variable COGS 557,600. You have to plus add with the variable selling and administrative expenses 170,000, and you have a total variable cost 727,600. In order to get the contribution margin, sale minus total variable cost, so you get contribution margin 972,400. And then you have to less with the fixed cost. You have fixed manufacturing overhead 180,000. You have selling and administrative expenses 170,000. So total of fixed cost is 350,000. So therefore, your net profit will be 622,400. So the difference of the net profit, absorption, and marginal costing. Absorption costing net profit have a total of 652,400, and marginal costing net profit you have 622,400. So the difference is 30,000. Why does it exist? The difference of net profit, absorption, and marginal costing. Why it exists? Under absorption costing, only partial of the fixed manufacturing overhead is expenses. Therefore, depends on the unit sold. And part of the fixed overhead is applied by the ending inventory. Depends on the unsold unit. While marginal costing, all of the fixed manufacturing overhead is expenses. No portion of fixed manufacturing overhead cost is applied by the ending inventory. Next, we have to do the reconciliation of net profit between the absorption and marginal costing. Net profit under absorption costing plus fixed overhead in beginning inventory minus fixed overhead in ending inventory. So we will get the net profit under marginal costing. Reconciliation of net profit based on Syarikat Semegah. Net profit under absorption costing 652,400 plus fixed overhead in the beginning inventory, where cost per unit fixed overhead is Rm 10 ringgit time beginning inventory in unit 2000, so therefore 20,000, less fixed overhead in ending inventory Rm 10 ringgit time 5,000, so the total will be 15,000, and the balance of 622,400 is equivalent with the net profit under marginal costing. If you are start with the marginal costing, therefore they have to plus with the fixed overhead in ending inventory and minus fixed overhead in beginning inventory, and the result will be net profit under absorption costing. Based on the Syarikat Semeggah, net profit under marginal costing 622,400 plus fixed overhead in ending inventory 10 ringgit times 5,000, 50,000, minus fixed overhead in beginning inventory Rm 10 ringgit times 2,000, so 20,000. So the result will be 652,400, equivalent with the net profit under absorption costing. So that's all for chapter 9. Thank you very much.